Anyway, we'll take this discussion forward. We have with us Anil Gupta, Senior Vice President and Co-Group Head of Financial Sector Ratings at ICRA. Mr. Gupta, welcome to this conversation. This is Vishwanath. Just the first question, in terms of the guidelines that the RBI is proposing to introduce from 1st April, what do you see as in terms of the impact on the entire banking sector? Is it largely going to be a NIM impact, or are there other things that we have to watch out for?
Yeah, hi, good afternoon. So we think that it is basically going to have maybe dual impact in terms of maybe not only the margin compression, because you have to possibly increase the high quality liquid assets to shore up the LCR, which we believe is going to be adversely impacted because of these regulations. There is quite a bit of a high penetration in many banks in terms of internet and mobile banking customers. And we have done some broad calculation, anywhere between, let's say, 30 to 90%, let's say, if that is the kind of penetration, the LCR may go down at a system level from 10 to 20%. So let's say 130 is the reported LCR at a system level. It may fall down to 120 or 110. So depending on, again, the number of digital banking customers. Now, our experience is basically when anything event happens at any bank, right, any kind of a stress event, we have seen from the past experience that the runoff rates are even higher than what the regulator has stipulated. So, one, we will not say that these are maybe something which is very maybe conservative rates maybe, and these needs to be brought down. It is, I think, a good enough, a welcome step in terms of shoring up of the liquidity, because you take care of the liquidity for the stress events, not only for the normal scenarios. And as the banks try to recoup the LCR, right, so incremental deposit mobilization, possibly one, you have to focus on the retail side, not on the wholesale. And second, you have to possibly deploy more of that incremental deposits towards HQLA rather than the credit. So it will have an impact both in terms of margin, because your HQLA levels will go up, and second, your credit growth will go down. Yeah.
Right. Anil, the broad consensus amongst the equity analyst side at least seems to be that public sector banks, because of the high retail deposit ratios that they have, they are likely to see more of their impact. Plus, of course, anybody with an LCR ratio of less than 120 is at risk of shoring up that liquidity at the earliest once these norms do come in. What is your outlook looking like in terms of the sector, if there's any breakup that you're looking at?
So there are different, let's say, way we can look at public banks and private banks. Our aggregate analysis shows that while at a system level the number is 130 on LCR for March quarter, the PSU banks had a higher LCR at 134 and private banks had a lower LCR of 125. But at the same time, the level of the wholesale deposits, right, that number is higher for the PSU banks. So that way, the ability of the PSU banks to possibly recoup the LCR number can be to shed these wholesale deposits. So that is one option. You don't take these wholesale deposits, reduce your outflow number on the denominator and recoup your LCR. So that can be one way. And nonetheless, when there is a competition from private banks, definitely the public banks have to step up. So we are going to see an inch up in the deposit cost, the funding cost, and possibly on the lending side, there can be some uptick on the lending rates also because of these changes.
Understood. Mr. Anil, Harsh also joining in. I want to try and get perspective, just take a couple of steps back and try and understand whether there is a genuine need, in your opinion, for something like this in terms of a change of norms and higher liquidity requirements. Is at a system level, do you find that there is a need for it? That is one. Second, do you believe that there is any concern? Has it reached a level where there is a concern with regard to how much liquidity banks are carrying?
Sure. So while we can say the liquidity coverage ratio is well above 100%, right, 120%, 130%, right? So that should mean that there is no challenge in terms of what maybe the liquidity is adequate, right? But at the same time, the question is these numbers in terms of LCR are driven by the assumptions on the outflow rate, right? Whether those outflow rates are correct or not, I'm saying that in an event of a stress, right, the number in terms of 5% on the outflow on the small customers and 10% on maybe the business customers, that number possibly can be much lower in terms of assumptions on the outflow. The actual behavior can be even, let's say, the more deposits outflow happen, right? And when you look at some of the banks, right, which are offering different rate of maybe interest on their saving accounts, and those saving accounts are instantly transferable, right? The deposit relationship with such a bank of such a customer is also interest rate sensitive, right? It's not a permanent kind of a relationship. You have accounts which are opened digitally. You are getting 7%, 6% on the saving account interest rates, and the relationship is more driven by the interest rates, right? So the behavior can be very volatile for such depositors. And what we have been using from the LCR guidelines, which were formulated a decade back when internet and mobile banking were not so prevalent, these rates needs to be looked at. And we have seen actually the outflow rates in the event of stress actually tend out to be more higher than these numbers which are specified currently in the regulations. Right. So that way it is a step in the right direction from the regulator.
Right. Anil, quick last question to you. In terms of the existing ecosystem where your credit growth rates are significantly higher than your deposit growth rate, are you also likely to? Are you also expecting to see some amount of slowdown on the credit growth side of the story? But then, of course, that has a direct impact on growth metrics as well.
Sure. So incrementally, like when we look at the credit growth, right, we look at the one on the percentage and one on the absolute amount of incremental credit flow. We already have our estimates which are lower in terms of incremental credit flow. So last year, if we exclude the merger impact of HDFC group, right, the incremental credit flow was somewhere around 22.5 trillion from the banking system. What we are expecting is that in the incremental terms, it will decline by almost 10% to close to 20 trillion. So one, you are declining in absolute amount. Second, you are declining on a higher base of the credit outstanding. So we internally have a view that the credit growth could be 11.5 to 12%. So we have not revised it downwards further based on this regulation, but definitely we have to relook at it. But internally we have a view that it will be lower both in absolute amount as well as percentage terms from the last year. And that is, I think, the regulatory objective is also to slow down the credit growth. And we have seen certain actions by the regulator around this, right, in form of risk weights in terms of this LCR. So these all are basically getting driven, and it is not April 2025 the banks will possibly start looking at this. Maybe they have to build up the HQLA in a run up to the date, right? So the impact will start coming from next maybe few months only, right?
All right, Anil, thank you so much for taking time out and talking to us. That was Anil Gupta from ICRA talking about the impact of the RBI's new norms on liquidity management by the banks. This was me and Harsh signing off from the big